Welcome to the Bulletproof Cash Flow Podcast, the go-to place to gain financial freedom through real estate investing. Here we interview investors, mentors, and entrepreneurs who share their secrets and advice to help you build passive income. Let's get into the show.
Hey everyone, this is Augustino. For many that want to invest in multifamily and commercial, it could be hard discerning what to invest in. So many investors seeking to invest in real estate for the first time are looking for vetted opportunities, rigorous underwriting, and a solid customer service experience handled by investment professionals. Well, today's guest sought out to do just that. Coming from a family of entrepreneurs, it's no surprise that our guest has created the leading platform in the real estate investing capital marketplace arena. She was a vice president at Union Bank and ran large sales teams that coordinated the efforts of registered investments with advisors, lenders, trust advisors, wealth planners, and worked on investment accounts exceeding $300 million. Throughout her career, she's personally underwritten over $3 billion of real estate, ranging from retail to multifamily, office, residential, mobile home parks, storage, pretty much everything under the sun. So leveraging her real estate experience, she and her partner have built a crowdfunding platform for real estate called RealtyMogul. And that allows investors to pool their money online and buy shares of pre-vetted real estate investments. So with all that, I'd like to welcome CEO of the company, Jilliene Helman, to the show. Thanks, Jilliene, for coming on. I appreciate it.
Yeah, absolutely. Thanks for having me.
So before we go on, if you like what Jilliene has to say, you can reach her at info@realtymogul.com. Okay, so go ahead and tell the listeners about what you're about and what you're up to.
Sure. So I'm the CEO at RealtyMogul, and we are a private markets investing platform for commercial real estate. So we connect investors who are looking to invest in commercial real estate with a variety of investment opportunities all around the country. Majority of our transactions have been in multifamily, about 60% of our business, but we've also done other types of commercial real estate like office and retail, industrial. So really love commercial real estate, love giving investors access to commercial real estate. And that's really been the focus for the last 6 years of building the business.
Excellent. Now, how did you get started in real estate? I know that your mother was a commercial broker, as far as I can tell, right?
Yeah, my mom was a commercial real estate agent. She did luxury residential real estate, so didn't do a ton of commercial, but my family was involved in commercial real estate. So my grandfather developed a property in Los Angeles. I started managing a small multifamily apartment building when I was about 16 years old. And then my dad owned some office and industrial properties through his business as well. He's an entrepreneur. So really learned about real estate around the dinner table. We're talking about real estate and how to make wealth in real estate. And I went on to work in banking after I came out of business school at Georgetown. And when I worked to work in banking, I was predominantly spending most of my time in wealth management. And what I found there was the majority of our wealthiest clients were real estate investors. They had exposure to real estate either through their investments or through buying properties outright. And I knew that I wanted to continue building my career in real estate.
And it's probably, a little bit after that when you saw this opportunity with the changes of the Jobs Act, right, which really helped launch your business from there, or really how did that come to be?
Yeah, so I was working in banking at the time, and I was doing some work in the risk management group of the bank, and I was asked to kind of look at the Jobs Act and figure out and assess if there was going to be any implications of the Jobs Act on the bank. And I came away with, I don't think there's going to be a lot of implications to the bank because it's just not kind of in the banking realm or in the banking business realm. But I thought that there was going to be a tremendous opportunity to raise capital on the internet to invest in commercial real estate. You have all of these people who are looking for investments, looking for places to put their money. And for the first time, you could really use the internet to facilitate that. So I just saw a huge opportunity when the Jobs Act came out, decided to quit my job and start the company. And that was about 6 years ago now.
Nice. And just for those that are listening, not really familiar with RealtyMogul, how does it differ from like Indiegogo and Kickstarter and some of these other ones out there that do similar crowdfunding type of things?
Sure. So Indiegogo and Kickstarter are focused on rewards-based crowdfunding. So if you give them money or you invest or back a transaction there, you typically are getting something physical. Maybe you're getting a t-shirt, maybe you're getting a movie, maybe you're getting, a handwritten card, maybe you're getting a board game, but you don't actually own the business, right? Or own a portion of the business. We think of ourselves really more as an investment opportunity. So if you invest with us, you're owning typically through ownership in an LLC or ownership in a REIT, you're owning real estate, right? And you get cash distributions off that real estate, potential appreciation off that real estate. So it's really more of an investment model as opposed to a rewards-based model.
Yes. Okay. Excellent. Well, one of the things that one of the huge benefits that RealtyMogul provides is access to some of these people that aren't too familiar with real estate, but again, they wanted that pre-vetted solution so they can go ahead and invest in that deal. So, what sort of people actually use your platform from the investor side of the house?
So I'd say that our average investor is relatively high net worth. They're making $200,000, $300,000 a year. So they've got, decent cash flow from their job, and they're looking for alternative investments. Maybe they've already invested in the stock market, maybe they've already invested in the bond market, but they want exposure to real estate, and they don't necessarily want to go deal with the hassles of tenants and toilets and trash and buying their own single family home or buying their own apartment building. It's hard to get access to these deals. So a lot of those investors have good strong incomes, but just don't want to deal with the hassles of buying real estate outright. We have people who come from the technology field. We have people who come from the real estate field, financial services field, CPAs, doctors, attorneys, entrepreneurs. We have over 160,000 members today on the RealtyMogul platform. So our investors and our members come from all walks of life. But in general, I think that they're looking for exposure to alternative assets, exposure to real estate to round out their investment portfolios.
Yes. And I mean, to me, it seems like it is definitely a much better opportunity than, say, just a REIT or something like that. Because you think the returns are going to be far greater. Same thing as typical syndication type model, right?
Well, we also offer REITs. So we offer investors kind of two different ways to invest with us. They can pick and choose an individual property, or they can invest in one of our diversified REITs, which are real estate investment trusts. So, we're believers in serving our investors the way they want to be served. If they want to pick and choose and sort of build their own portfolio, they can do that. If they don't have the time to do that, they can also rely on us to pick and choose the transactions that go into that diversified pool through the REIT.
So on the other side of the house, now you have the real estate entrepreneur or real estate business that could bring a deal to RealtyMogul to be placed on the platform. So what does that person typically look like? What sort of experience or deal size do they bring to the table in order for you guys to sponsor it or bring it to your members?
Yeah, so we typically work with real estate companies who have done, anywhere from 50 to $100 million in transactions before they work with us. So we really want to see that they have a track record of success. They've done this business plan. They've done it in the same market. They have a team built up. Kind of, they know the perils and the pitfalls of investing in real estate. And so these are real estate companies that are established. They're doing this full time. They're professionals. They would call themselves entrepreneurs. They're building their own businesses. And those are kind of the types of folks that we tend to work with.
Yes. And and it seems like for those guys that are trying to raise all that money, I mean, typically they have, I'm going to call it a spigot of capital available to them. And there's other ways to raise money. What sort of advantages do, say, someone that's done 60 million in transactions, what sort of advantages they have bringing it to your platform versus trying to do it on their own? Like, is there an advantage for them or what?
Yeah, it saves them time and energy both when they do the transaction and through the life of the transaction. And we also help with best practices. For example, working a real estate transaction, acquiring real estate, executing on a value add business plan, operating that real estate, it's a very different skill set than raising capital. We think of ourselves as the capital markets arm to a lot of those real estate companies. And the way that we structure our transactions is that all of our investors invest into a single entity with us. And then we make a single investment into the real estate. And the reason that we do that is multifold. One, we think that it's better for investors because we have sort of collective bargaining power. We can make decisions on behalf of investors. We can require approvals on capital expenditures, annual budgets, loans, et cetera. So that's one thing that I think is really, really critical. And then it's also great for the real estate company because that real estate company is able to have effectively one investor. So we might have 50 investors in the transaction, but we look like one investor to that real estate company. So the management of that is a lot easier. And then we also provide best practices. So we show these real estate companies what's the best way to report, what are the minimum reporting requirements. We have an asset management team that is digging into the transaction. So we, in many cases, will have an idea for what they can do with the property. How can they reduce expenses at the property? How can they generate additional income at the property? Because we're invested in nearly $2 billion of real estate across the country, we see a lot of what's happening in the market and we know where there are opportunities. So for example, maybe there's an opportunity to bill back utilities directly to the tenant to reduce expenses, which is going to reduce potential income in the transaction. That may not have have been in the original business plan, and we'll add that into the business plan. Maybe we'll ask the real estate company, did you think about installing washer and dryers in the units? And here's a vendor where we purchased cheap washers and dryers on for another transaction that was, in the same city as this transaction. So we add a lot of value to the underlying real estate, or we try to add a lot of value rather in our relationship with those real estate operating partners.
Yes. Oh, but you know what, though? That's the thing. When, especially working on a larger deal, if you have 30, 40, 50 investors on a single deal, trying to manage all that is really quite a pain for just a regular old syndicator. So that value alone that you guys do is huge. And I mean, not to mention also looking over your shoulder to make sure that you're catching all the opportunity that there is out there. So that's amazing. That's good stuff.
Yeah.
So now, how does RealtyMogul define a good deal then? Are you guys looking for a specific deal size? Because it seems to me that those deal sizes must be fairly a little bit on the bigger side is what it sounds like.
We tend to look at transactions in total transaction volume, kind of between like a $10 million acquisition and a $30 million acquisition. We play kind of in that middle market space where there's less institutional competition. We think that there's potential for better returns in that space because there's less competition. But that's kind of where we look as far as deal size. And there's always exceptions to that, obviously. We're willing to look at smaller deals or larger deals, but that's probably where the majority of our transactions have sat.
Yeah, the deal sizes out here in Ohio anyway, for a typical Class C property sits at about 30,000 a door currently, a little more, but that's typical. We're actually working on one deal right now. It's 130 units for just over 4 million. Something like that might seem a little bit small for your platform then, but it sounds like you wouldn't necessarily throw it out, but you would consider backing such a deal, right?
What's the total capitalization?
Total cap is, we'll call it 4.1.
That's probably too small for us. We tend to really not do anything less than kind of 8 million, probably. Maybe we've done a $6 million deal here and there, but 4 million is probably too small for us.
Yeah, it makes sense for much larger deals. And so typically then, what would you say it takes in terms of size to raise the money required for such a deal? Like say for a $10 million deal.
So a $10 million deal, we'll usually see about 70% leverage. So on a $10 million deal, you might have a $7 million loan, and then you'd have $3 million in equity. We are willing to be up to 90% of the equity. So that would be $2.7 million out of $3 million. We'd require that other 10% to be invested by the real estate company that we're working with to make sure that they have, skin in the game.
Sure. Direct investment then. They can't go off and borrow that money or even raise it from their own sources?
Correct.
As far as time frame, typically, how much time does it take to raise that capital on your end?
Usually pretty fast. 30 days, let's call it. It depends obviously on every transaction, but 30 days plus or minus. Sometimes it's overnight, it just depends.
And as far as SEC and preparing all the documentation around that too, from a syndication perspective, we have to go and of course line all that up. In this case, though, all that's not really necessary anymore now, is it?
Well, we'll do all those filings. So we'll do, regulatory filings on behalf of the entities. We put together operating agreements. We have stock operating agreements now. We've done this, over 100 times. So we have a lot of the stock legal agreements that we review, on a regular basis. But we can streamline that pretty substantially, and we can bring the legal costs down pretty substantially because we've done a lot of this and templated as much as possible. Every deal still has negotiation. We have an attorney involved in every transaction, but, we can streamline quite a bit of it.
Nice. It seems to me like this is a great platform for much larger deals. It's easier to raise the capital, provided, of course, that management company has that 10%. So, which they usually do, I would imagine, right?
Yeah.
Okay, good. As far as the future of multifamily and crowdfunding overall, how do you see the future going for the business and for the crowdfunding platform as a whole?
We're continuing to invest. We're continuing to do what we're doing. I think that the market is not at the bottom. I can tell you that much. I don't know if we're at the peak yet, but it's definitely not at the bottom. So we're taking a pretty defensive investing strategy. We really like multifamily because there's cash flow. So, I'm very much a believer in current cash and not all back-end appreciation. There's some instances where back-end appreciation makes sense, but I really want to look at current cash. Interest rates have moved up, so that makes it a little bit harder to generate the cash on cash yields that we've been generating over the last 6 years. So I think that investor expectations are going to have to come down a little bit as a result of where interest rates are moving. But I still believe, personally, that real estate is a great risk reward investment opportunity. So I think that there's still a lot of opportunity. There's a huge supply and demand issue in the United States, right? I read an article recently that we need 4.6 million more housing units by 2030 in order to house all the people who want, apartment housing in the United States. And that's a big number. It's gotten very expensive to build multifamily. We have a shortage of workforce housing. We have a shortage of kind of everyday housing for people. So my belief is that you have a lot of demand for multifamily. You have limited supply for multifamily, especially in specific markets, not in all markets, but in many markets. So I'm a big believer in this asset class over the long term.
Nice, good. Now, as far as markets are concerned, what sort of markets are you guys coming across that are just super hot, or which ones are some of the ones you'd actually stay away from?
Yeah, so stay away, I would say anything like Balkans, North Dakota, we're out of that market. We've seen a zillion opportunities to invest in workforce housing and sort of the new resurgence of energy that's happening there. We've said no to all of that because I don't think that the demand drivers, make sense long term. We're investing a lot in Texas. So we've done a lot in the Dallas Fort Worth area. We've invested in Austin, Plano, Irving, Mesquite. I mean, a lot of the Texan markets, which we really like because of number one, the tax treatment for people. And so that's driving a lot of people moving into Texas. Number two, the jobs and the job creation. So Texas is a very interesting market for us. We've done, a handful of things in Atlanta, in the Georgia sort of greater market. We've invested in New Jersey. We've invested in Brooklyn. We've invested in, a number of secondary markets in California. We tend to be secondary markets investors. We don't invest in a lot of core assets. So you're not going to find us in Manhattan. You're not going to find us in Beverly Hills. You're not going to find us in, San Francisco proper, because we just can't generate the cash flow. And we think that generating current income and current cash flow is a really important part of the equation for overall risk and reward.
Yes, absolutely. No, I'm feel the same way. We do our live events out here. We had one just the other day, and one gentleman, he's a believer in appreciation, and in a market like Cleveland, Ohio, it's a big risk to play.
Yeah, in a market like that, we would underwrite probably little to no appreciation, and we'd really be looking at just cash flow, right? So what can we generate from income on the property? Maybe you have a little bit of appreciation, but I don't think that you're going to have a lot of appreciation. So
Yeah,
we wouldn't focus on that.
that's exactly how we underwrite today. Oh, how do you see expansion of, like say, Amazon, for instance, moving into certain markets? Does that make a difference in terms of you getting into a certain market? Like, because I know that Amazon's throwing a lot of money into, say, Cleveland. Does that have any impact on your decision to invest in a given area?
I wouldn't say Amazon in particular, but job growth, 100%, right? We're always looking at who are the major employers in the market, what are the opportunities for job growth in the market. That's really critical to us when we do our analysis and when we do our underwriting. Amazon, kind of with the dual headquarters, New York, Virginia, like I think Virginia is really interesting. I probably wouldn't look at New York because it's just overpriced or relative to where I think that we can make money elsewhere. But yeah, job growth is critical, right? It's one of the reasons that we like Texas so much, and the Dallas Fort Worth area in particular. You've had tremendous job growth there. So job growth is critical to underwriting a real estate transaction and understanding, particularly, multifamily, if people are going to want to live there, right? People live where there are jobs. That's the way that they afford their rent. That's the way that they pay for their lives. So we don't want to be in markets where there are not a lot of employers.
So aside from jobs, do you have any other underwriting criteria, any other things that you're looking for aside from that?
Oh, we're looking for a lot. We're looking at who's the tenant base, what are the comparables, what are the rent comparables in the markets, what are the sales comparables in the markets, what are the demographics of the tenant base, what's the population size within a 1-3-5 mile radius, where has the market historically performed in the 2008 recession? Where did the market dip to? What was liquidity during that recession? So we've got a very, very strenuous underwriting program here so that we can really understand the nature of the real estate, right? There's still risks. There's always risk when you invest in real estate, but we really try to get an understanding of those risks. You have to take risks to make money. It's just a matter of how well do you understand the risk and how well can you predict the risk. That's really what we strive to do. And it's one of the reasons why we really like multifamily. Multifamily is a more forgiving asset class than some of the other asset classes. You think about, office, for example, maybe there's only a couple of tenants, 2 or 3 tenants. You lose one of those tenants and suddenly your business plan is totally out of the water. You lose one tenant in a 100-unit multifamily building and you barely even notice. So, we like diversified multifamily as a result of that.
Yes, that's exactly why I love multifamily as well. It's not a big fan of commercial, not a big fan of fix and flip, just multifamily. That's it. That's it for me too.
Yep.
From a technical perspective, then this sounds like everything you built was all done in house, right? As far as all these models, everything else like that that you just identified, right?
Yeah, we do all of our underwriting in-house. It's too critical of importance for our business to outsource something like that. So we run it all in-house. We have investment committee meetings. Our investment committees are unanimous. So myself and our chief investment officer, have unanimous decision making. We also have an independent board on one of our REITs. So transactions will percolate up to our independent boards. We've really put in place, structures to make sure that we are hopefully making proper risk reward decisions, right? Again, there's risk in every transaction, but the idea is that can we understand the risk and can we make sure that, we think we're getting paid effectively for that risk?
Yes. So one of the things that I encounter in our, in our live events, just in talking to people about getting into this business, is how to get started. What advice do you have for someone that grew up around this and have a wild success with RealtyMogul? What advice do you have for those people who are just getting started?
My advice would be to get in and start learning, right? I mean, in our REITs, you can invest with a couple $1,000s, and any investor or most investors can invest in them, whether they're accredited or non-accredited. And the beauty of it is then you're going to get quarterly updates, right? And in our quarterly updates, we're going to tell you about the properties that we invest in, and you're going to learn from that. And you're going to be in, whether it's our database or someone else's database, we send a lot of educational materials. We have a couple hundred blog posts. So read and get started, right? When you have real money in a transaction, you follow it, right? You care more. You can commit to educating yourself, but if you have a couple $1,000s or $100,000 or $200,000, in the investment, you're gonna really read. You're gonna read those updates. And you're gonna start learning about real estate. So that would be my recommendation: is you just got to jump in, right? And you got to jump in with 2 feet. You can start with a small amount, thanks to digital investing. You don't have to start with a huge amount. You can if you want, but you can start with a small amount. You can track it and start watching it, watch how it works, and learn.
Yeah, well, I think that's exactly right. They have skin in the game. They will pay close attention to how things are going. And I think by you providing that information, it allows them a mechanism to actually learn how this game works. So absolutely. Good stuff.
Yeah.
Okay, well, good. Let's get into the bullet round where I'm going to ask you some questions and more of a personal thing to understand a little more about you. So you ready?
Sure.
All right, excellent. So if you can give your 20-year-old self a word of advice, what would you tell them?
Be patient. I didn't have a lot of patience in my 20s. My 30s brought patience, which I wish I had younger in life.
What are your 3 most influential books and why?
So I have 2 favorite books that are now tied, and one I just read, and I read a lot. It's really cool to have just found a new favorite. But one of my favorite books is The Everything Store, which is the story of Amazon. And it really gets you thinking about building a business for multi-decades and having, a multi-decade strategy. I mean, you look at Bezos, and he started with just books and perfected that before he moved to other things like toys and clothes. And, now he's got Blue Origin, the space company, and he's got AWS, which is their, cloud-based company. So it's a really, really cool book of just kind of how long-term Jeff Bezos thought and some of the strategy that he had as a result of that. So that was really used to be my favorite book. My current favorite book is a book called The Outsiders, and it's a pretty, dorky book, if I do say so myself, but it's about capital efficiency. And it follows some of the best performing publicly traded stocks over decades. And it talks about when to do stock buybacks, when to acquire companies, when to sell companies, when to buy companies, when M&A doesn't make sense, when to stop doing sales in your business, really thinking about margins. And it's a really transformative way of thinking. So I really love that. I just finished it and bought, 10 copies of it for a handful of my employees who I wanted to sort of think the way that I was thinking. So that's a really, really great book. And then another book that I love just because it is wholly entertaining, and I tend to read business books, so that's kind of where, the genre that I like, but it's called Hatching Twitter. And it's one of the most entertaining startup books that I've read. It's about the story of Twitter, how it was created, CEOs being fired, CEOs coming back, tons of infighting, really a disastrous story of how they built Twitter, but it's very, very funny. So I read that in one sitting on a Saturday afternoon. It was just cracking up. So from a sort of jovial, funny book that you can also learn from, Hatching Twitter is a good one.
Excellent. I'm going to check that out. Actually, I think I may already have that one. I got to listen to it then. Awesome. All right. Well, good. So, and finally, what's your philosophy for life and success? So, what motivates you?
Yeah, my philosophy is always changing as I get older and I get more mature and I learn, about the world. So you could probably ask me again in 5 or 10 years and it might change. But my philosophy today is show up, be present, and stick it out. So show up, do the absolute best that you can do, be really present with the people who are in your life, whether that's personal or professional, and stick it out. It's hard. Building a business is hard. Relationships are hard. Eating healthy is hard. Exercising is hard. So stick it out and just get it done. Kind of coupled with the patience that I've really learned in the last decade, I'd say that's my philosophy is I'm not I'm not in as much of a rush as I used to be. I'm really, a lot more deliberate, and I'm willing to slow down and really be present with people. And that's a great gift.
Yes, it is. Excellent. All right, guys. Well, if you want to reach out to Jilliene or the company, you can reach her via the contact page at RealtyMogul.com or at info@RealtyMogul.com. I hope you guys got a lot of insight, not only on how the crowdfunding business model works, but also how real estate entrepreneurs can leverage online real estate capital marketplace to connect with their investors. So thank you very much for your time, Jilliene. I really appreciate it.
You got it. Thank you.
Thank you for listening. We hope you enjoyed the Bulletproof Cash Flow podcast. For more free podcasts, articles, videos, and resources, go to www.bulletproofcashflow.com.